Current account surplus continues into the September quarter as well, and this time around it's increased actually compared to even what it was in the previous quarter. Remember that in the previous quarter India had recorded the first quarterly current account surplus in I think more than 10 or 11 odd years, but that was at a more modest $0.6 billion versus 19. Okay, this is the April to June current account surplus, which stands at $19.8 billion. That's 3.9% of GDP. When you compare it to last year, it was obviously a current account deficit at 2.1%. This is, of course, largely coming in on the back of course, a sharp contraction in trading as well, done in trade activity done. Let's go across to ET Now's consulting editor Maithili Bhusnurmad to analyze these numbers for us and how important are they from the scheme of things. Maithili?
Well, yes, this is the first official data that we have from the Reserve Bank of India. Of course, it was known that the first quarter of this fiscal had seen a current account surplus, but now we have the authentic information from the RBI, which says that the first quarter was a current account surplus, almost 4% of GDP, as you mentioned, as compared to a very small trade surplus in the previous quarter of just 0.1% and a deficit of 2.1% in the comparable quarter of the previous fiscal. Of course, this is mostly because of the sharp contraction in the trade deficit, which occurred mainly because of the slowdown in activity. Remember, these were the months which coincided with the lockdown from March. We saw the lockdown, so there was virtually very little imports. Imports contracted very sharply, as a result of which the trade deficit has contracted, and which is why we have a current account surplus. And at the same time, we also saw a huge accretion to the forex reserve, as much as close to 20 billion, 19.8 billion to be precise. But while a lot of people might celebrate a current account surplus, remember, for a developing country, a current account surplus is not good news because it actually reflects an outflow of capital. Developing countries should actually aim for a deficit on the current account, which means since it is a balance of payments, which you have to balance, a deficit in the current account means a surplus in your capital account. That means you get inflows. So the aim of every country, a developing country, should be to run a moderate current account deficit. So the fact that we have a current account surplus is really not good news for us. It really reflects that the economy is not doing well. It's because the economy has slowed down that we really ran a current account surplus. As long as the current account deficit is up to 2.5, that is good news for our country. So I'm afraid this is not really as good as it sounds. Surplus normally sounds like good news, but in the case of a developing country, a current account surplus is not good news.